The UK economy has been hit by inflation, rising mortgage rates, and soaring living costs. Yet house prices barely flinch. Instead of collapsing, they cling stubbornly to the peaks built during the pandemic boom. Renters are stuck, first-time buyers shut out, and landlords are squeezed between rising costs and tightening rules. Everyone feels the pressure, but the crash never comes. Is Britain defying financial gravity or simply delaying the inevitable? It didn't start with chaos. It started with opportunity. Cheap borrowing fueled demand during the 2020s, pushing prices to new heights. Mortgage rates hovered around historically low territory until they didn't. When the Bank of England hiked rates to fight inflation, affordability should have collapsed. A crash should have begun. But instead the market accelerated. Buyer demand rose 11% year on year, and sales agreed increased 8%, defying seasonal slowdowns and economic anxiety. Even in July, typically sleepy in housing, activity surged as households rushed to secure homes before the summer slowdown. More homes came to market too, with 12% more supply nationally, giving buyers choice without pushing prices down. The average UK house price hit £268,400, up 1.3% in 12 months. Not a boom, not a crash. Something stranger, a market refusing to move. The surge was helped by policy. Government interventions like Help to Buy have long propped up lower-end prices, ensuring falls are quickly reversed. Stamp duty cuts, lending tweaks, and demand spikes have become political tools, and it worked again. Pandemic-era demand changes also played their role. The race for space, a sudden hunger for gardens and extra rooms. Yet, even that narrative has cracks. As one research note observes, higher-value rural listings surged not because everyone fled cities, but because many elderly homeowners passed away during COVID, releasing more spacious homes into the market and skewing the mix. Sellers asked for more. Buyers paid more. Confidence soared. But behind all that upward movement, pressure was building, quietly. For every sold home, there's a story of someone left behind. First-time buyers now face higher stamp duty costs, rising from 19% liable pre-April to 41% today. That makes saving for a deposit harder and passing mortgage affordability tests tougher. Homeowners aren't spared either. Before April, 49% paid stamp duty. Now 83% do. These extra transaction costs pour cold water on demand. Yet cash buyers, investors, downsizers, international buyers feel none of that pressure. They move freely. The result? Demand remains artificially high at the top and hopeless below it. There's a visible generational fracture. Young adults rent into their 30s and 40s. Many move back in with parents. Wealth concentration grows, not through wages, but through property inheritance expectations. And that expectation becomes political fuel. Governments fear upsetting those with homes, fear the anger of those without, fear the price falls that could swing elections and wipe out billions in household wealth overnight. The market isn't just an economy, it's a pressure cooker. Mortgage rates jumped sharply, but homeowners survived. Why? 2 reasons. Strong labour market, unemployment remains low, wages stable. Most borrowers can absorb higher payments. Mortgage stress testing. Since 2014's Mortgage Market Review, new loans have been tested for rate rises years in advance. Borrowers entered this crisis tougher, more resilient, less vulnerable to default. The result? Rather than selling up, people freeze. They cling on, they wait it out. Those who fixed at low rates face looming expiry, the refinancing cliff edge. Yet instead of panic selling, they tighten budgets, remortgage on longer terms, or switch to interest-only deals. Meanwhile, landlords aren't so lucky. Interest relief reforms cut profits, insurance and service charges spike, licensing rules expand, eating margin. Normally, forced landlord sales would flood the market, but something strange is happening. Investor exit intentions are rising, but listings are not. Holding is safer than testing a volatile buyer pool. Every sector is stressed, yet inventory stays locked. And when fewer homes hit the market, prices don't fall. They stagnate and stubbornly rise in pockets. Here's the uncomfortable truth. Britain's affordability isn't broken because prices rise. It's broken because incomes don't. Even modest price inflation creates widening gaps. For millions, renting is now more expensive than buying, on paper. But deposits and stress tests make the jump unreachable. Council waiting lists remain long. Social housing shortages push more families into private renting. Rent rises, then feed home buying pressure higher. It's a loop, engineered by scarcity. Every missing home deepens the crisis. Governments talk about house building, but supply is overwhelmed by demographic growth, smaller household sizes, investor purchases, under-occupied second homes, inheritance-driven concentration of wealth. Even when more stock enters the market, like now, it's still not enough to shift power to buyers. Prices don't fall when supply rises slightly. Prices fall when confidence collapses. And right now, confidence holds, barely, but it holds. Crashes aren't about high prices. They're about sellers forced to sell. That isn't happening. Listings rise, but slowly. Demand rises faster. Transactions increase, but selectively. Zoopla shows activity stronger across all regions and countries of the UK, with agreements still up year on year. This isn't a lively market, it's a petrified one. Buyers wait for bargains that never come. Sellers wait for offers that match past peaks. Nobody moves unless they have to, so valuations creep instead of crash. Low single-digit inflation, forecasted at approximately 1% for 2025. But this is where danger hides. Fall-throughs rising, down valuations rising, confidence fragile, debt rolling into higher rate terms. The market isn't healthy, it's anaesthetized, numbed by policy support. One jolt, and things could change fast. The collapse won't start with buyers, it'll start with confidence, somewhere else. Possibility 1, a major house builder falters, new supply dries up, sales agreements slump, developers already warn profit softness. Possibility 2, a tightening of landlord regulation pushes portfolio sell-offs, but buyers aren't there to catch the falling knife. Possibility 3, the Bank of England is forced to raise rates again, sparking the wave stress tests warned about. In the 2008 crisis, the UK deployed mortgage rescue and homeowner support schemes. When loans became risky, government underwrote bank losses. Investors were shielded, prices stabilised. That precedent remains. If weakness appears, the UK steps in. Politically, it must. House prices are directly tied to middle-class wealth perception, retirement strategy, electoral loyalty, confidence in government. And governments know when house prices fall, votes fall with them. That's why this market isn't normal. It's protected, insulated, too socially expensive to fail, until that becomes too financially expensive to maintain. Housing isn't just an asset, it's a political weapon. Policies that could reduce rents or increase security for tenants risk triggering sell-offs, and therefore price falls, which risks political suicide. So instead of structural fixes, governments choose just-in-time patches, shared ownership, stamp duty tinkering, developer incentives, help-to-buy cycles, lending tweaks, temporary relief, permanent consequences. Every support measure deepens dependency. Buyers expect price rises, banks expect collateral strength, older generations expect inheritance windfalls. Property becomes a promise that politicians dare not break. So the market stretches further and further, stronger, number, just more fragile. Despite stagnation fears, prices still rise unevenly across Britain, where prices grow faster, where prices barely move or fall. Belfast plus 6.6% year over year, London plus 0.2%, Liverpool plus 3.3%, Portsmouth minus 0.9%, Sheffield plus 2.7%, Bournemouth negative 1.1%, Northern England / Scotland hold 2 to 3%, Southern England mostly below 1%. A new north-south divide. The north rises from a lower base. The south drags under higher stamp duty costs, now up to plus £2,500 per sale on average homes. London homeowners particularly strained. Average FTB stamp duty, £6,100 compared to £0 before April. This isn't a bubble, it's a stalemate. A country where everyone waits. Buyers wait for relief. Sellers wait for recovery. Politicians wait for polls. No one wants to blink. House prices may not crash today or tomorrow, but pressures are making land, Britain's safest asset, feel dangerously unstable. Refinancing risk rising. Supply still nowhere near need. Wealth inequality tied to inheritance. A generation locked out. Political fear blocking real reform. This isn't a market soaring. It's a market balancing on policy stilts, and stilts wobble. The real question isn't whether a crash is coming, but who will pay the price when the support runs out. So what do you think? Will the UK housing market finally break, or will the system bend just enough to survive? Comment below, and let's talk about Britain's future.